In this video, we will go through the recent Q1 earnings for Capitaland Integrated Commercial Trust, Capitaland India Trust, and Capitaland Ascendas Reit. We will see what are the green and red flags that we can take out of their business updates and how it might affect the next quarters when they announce their dividends. Let's get right into the first REIT, and that is Capitaland Integrated Commercial Trust. For those who are new to CICT, they are a REIT that focuses on retail, offices, and integrated development, which are mixed-purpose buildings. Although they have properties in Singapore, Germany, and Australia, most of their properties are based in Singapore, which is very good. In recent times, they have been active in making big changes to their portfolio, with the sale of 21 Kuala Kueh for 688 million, while buying 50% ownership of ION Orchard for $1.85 billion. These are big moves that we will see if it benefits shareholders in the long term. Looking at the revenue and net property income, it does not look so nice because it's down year over year of 0.8%. However, if we look at the main reason, it was because of the exclusion from the asset that was divested, thus bringing down the revenue and NPI of office assets. If we see the other two assets, they are still increasing in both revenue and income. Moreover, I expect their next quarter result to be better because the current results excludes contribution from Capital Spring and ION Orchard, which will make significant contribution to their revenues. At this moment, I feel that CICT will do better than most REITs because they have lesser amount of debts that needs to be refinanced within these 2 years of higher interest rates. As long as interest rate comes down lower by 2027, I'm sure that the refinancing of the debts will not be an issue for them. With the potential for refinancing of their debts, it's important to see what is their debt profile. What is the good news that we can see here? Like I mentioned, because for REITs with higher average cost of debts, they could see a peak in their costs. This can be seen from CICT as their cost of debt dropped 0.2% quarter over quarter, even though their borrowings went up to 9 billion. So imagine with CICT having such a good credit score, their cost of debt average is around 3.5%. This can be a good benchmark for other REITs to know what will be their expected average cost of debts as they refinance their portfolios. Occupancy-wise, property classes across the portfolio is decent at the highs of 96%, which did not have much change. Rental reversions is very important for REIT as they are organic income growth for REITs. This is due to additional income that they can get from the renewal of higher leases payment. For CICT, it's performing well with retail properties having a 10.4% rental reversions. With higher rental reversions, leases expiring will be good for CICT as they can be renewed for higher income. With 11.6% of retail property leases that needs to be renewed, it will definitely be beneficial for CICT, and I expect higher income this financial year. One of the risks is the retail portfolio in the tenant sales. Like I mentioned previously, for retail properties, shopper traffics and tenant sales are very important parameters for this property class. We can see that even though it's up 17.5%, it was mostly contributed from the inclusion of ION Orchard. If we exclude the new addition, tenant sales was actually negative 0.5% year over year. Drop in sales is never good as it will have a delay effect on tenants' willingness to rent in the shopping mall. This will result in lower renewal or occupancy of the retail properties in the future. Moreover, with the RTS link from Singapore to JB being built, it might also have an impact on shopping malls in Singapore in the future. So what can we conclude from this Q1's business update? Good point is that income is expected to increase with finance costs expecting to drop thanks to lower average cost of debt. However, the risk is that the retail properties, which is the majority of CICT's portfolio, continues to experience weaker tenant sales, which might have a lagging effect in the future for shopping malls. At the current share price, with semi-annual dividends given, it's at a dividend yield of 5.3%. At this moment, CICT should continue to perform decently with slightly higher dividends, but at a dividend yield of 5.3%, it's one of the more expensive REITs. Let's go on to the next REIT, and that is Capitaland India Trust. CIT is a REIT that focuses fully in India market. Currently, majority of their properties are IT parks. They also have portions of logistics facilities and data centers. With the increasing demand for data centers due to AI development, having DCs is definitely beneficial for the REIT. For this quarter's results, they continue to perform well, similar to last quarter where they announced higher property income of 12% year over year. However, in the last quarter, we have stated that the issue was their raising finance costs. They do not report it this quarter, but next quarter we will see when they announce their dividends. Their dividends has been dropping thanks to the increasing finance costs that has negatively impacted the REIT. So, as I said, the biggest risk now for CIT is their debts. If we see their debt maturity profile, they have refinanced most of this financial year's debts of 400 million to 170.7 million. Although their cost of debts did not increase, they actually took on more debts, which resulted in their gearing ratio increasing from 38.5% to 41.5%. Usually, it's risky for REITs to actually have leverage ratio above 40%. Moreover, they do not have a very high interest coverage ratio thanks to the high cost of debt. As they refinance these debts, we will have to observe the growth of the finance cost to see how they perform. For their rental reversions, it's decent as most leases are coming in positive, in particular in areas such as Selangor and Senai, which is showing double-digit rental reversion growth. For their lease expiry, there is not a lot to renew as only 7% will be expiring this year. So what can we conclude from this business update? Their 90% dividend payout is good as they are keeping a certain portion of their income for growth. Next, the property incomes are still performing well, but the risk is that the finance costs might continue to increase as the REIT refinances their debts. This will potentially be the main factor for their subsequent drops in their dividends. Another factor is the foreign currency risk due to the weakening of Indian rupee to SGD. As they earn in rupees, the conversion back to Singapore dollar will be lesser if the foreign currency gets weaker. At the current share price, its dividend yield is approximately 6.6%. However, considering the drop in the dividends expected and the weakening of the Indian rupee, I might not have so much optimism that their dividends can grow in this financial year. Now let's go on to the last REIT, and that is Ascendas Reit. Ascendas Reit is one of the largest REIT in Singapore that has a very diversified portfolio. They have properties mostly in Singapore at 65%, while other countries are in the US, Australia, and Europe. With so many different properties, what gives Ascendas Reit the advantage is that when they make improvements to certain properties, the temporary downtime due to the improvement will not greatly affect the overall income. With the flexibility, just this quarter alone, they have completed the acquisition in the US, redeveloped properties in Singapore, and performed asset enhancement to some properties. This will be important in increasing the property income of Ascendas that should kick into effect for this half's result. This will potentially provide higher dividends for shareholders. Moreover, the management have been actively improving many of their assets, which can be seen from the list of portfolios here. Out of most REITs, Ascendas Reit has been the more active REIT that makes lots of improvements to their asset, which is good for higher income. They also hold a well-balanced decent assets in the three classes, which are the business and life sciences, logistic, and industrial/data centers. Unfortunately, this quarter saw a slight decrease in their occupancy for all the properties in the respective countries. We will have to continue observing the occupancy, in particularly Australia, which has a drop of 7% year over year. So, how can we dig deeper to see the performances of their assets? We can see the rental reversions to get the full story. For all the portfolio, they are doing fantastic with 11% increase across the board. Moreover, Australia logistic properties came in at a high of 59% rental reversion. So this meant that Australia logistic properties are actually in well demand. So if we see their Australia occupancy, it declined due to a single tenant in one logistic property vacating. Therefore, occupancy dropped from 100% to 0%. Looking at their rental reversions for logistic properties, it will not be a concern for them to find a new tenant easily. So this is how we can conclude that the drop in occupancy for these Australia properties will not be a concern. With good rental reversions, it's always desired to have leases expiring, as this provides REIT with higher rental income upon renewing these leases. For Ascendas Reit, we should expect more income with 12.6% of their leases expiring, with 79% of it coming from Singapore. For their leverage ratio, it increased from 37.7% to 38.9%, with interest coverage ratio at 3.6 times. Average cost of debt has dropped from 3.7% to 3.6%. Similar to CICT, which has a good credit rating of A3, this has indicated that the cost of debt for Ascendas Reit most probably have peaked and is definitely good news for shareholders. This would mean that the subsequent quarters, the finance costs might be stable. For this quarter, about 265 million of their debts were refinanced and the cost of debt still dropped. This is very good, as this might indicate that the subsequent refinancing of the remaining 15% of their debts and subsequent loans might not result in higher increases in their finance costs. Overall, in summary, what are the positive pointers for Ascendas Reit? With higher rental reversions and additional contribution from their new properties, we might expect their income to increase in this first half of 2025. Finance costs might be stable or decrease, further benefiting the REIT. With the possibility of higher income and lower finance costs, this will definitely lead to higher dividends. At their current share price, it's priced around 6%, which is decent considering there is expected of dividend growth. Overall, CICT and Ascendas Reit continues to perform well with higher property income and the possibility of decreasing finance costs. For CIT, it is to be seen whether the increase in the property expenses and finance costs will still be a problem for them. Thank you so much for watching. If you like the video, please support the channel by hitting the like, subscribe, and comment your thoughts on Capitaland Reits results. We also appreciate your support by using the links below for free to help the channel out. Mapletree Reits also recently announced their results, but there were various reasons why they did not perform well, which you can see here. You can also watch the other video where I talk about the recent bank's earnings and why they are still the best dividend stocks in Singapore. Thank you, and I'll see you in the next video.